And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Luke Smith, good afternoon and welcome back.
Thank you very much.
Yeah, weekend's looking good, isn't it?
Oh, yeah. Go Raiders.
Go Raiders. Yes, there's a lot of excitement building around the town for the big game. 4 o'clock Sunday afternoon, and we'll talk a bit more about that later in the program. But today you have a much more pressing matter to discuss. It's more important than the Raiders.
Oof.
It's...
Oof. Don't know about that this week.
All right. Today's question: should I always max out my super contributions regardless of my income level? Now, I'm going to take a wild stab in the dark and say, well, maybe not. But you're here today to explain why.
Yeah, look, exactly. This one has come up a number of times in the last couple of weeks, and let me start this by saying the behaviour and intention that people have is wonderful. They're trying to be proactive, add to their super, and think they're doing the right thing. But we'll point out now, you could actually be doing yourself a disservice, and there's a better way to do and achieve what you're trying to achieve and avoid paying tax at all. So what do I mean by that? We know that if we put money into superannuation, we generally pay 15% as the contributions tax, and everybody's the same. Now, there's some additional tax that's paid if you earn over a certain amount, but let's not worry about that today. So if I put money into superannuation through my employer, salary sacrifice, I pay 15% when it goes in and the fund takes that money. Or I can make a contribution anytime during the year with my own money, and then I lodge what's called a notice of intent with the fund that says to the fund, hey, I've put in X, I'm going to claim X. Now, what I want people to think about today is, what is your taxable income? Because the intention of adding to super to build wealth in a very tax-effective environment is a wonderful initiative, and it's great behaviour, and I'm a massive advocate of people doing that during their working journey and leading into retirement. But what if you don't earn 100 grand? So my point here is this. If we look at a wage of $50,000, okay? If you're earning $50,000 in salary, you're going to pay tax of just over $6,500 because you're going to work your way up the sliding scale. You get the first 18 for free, then there's 19, then there's 34, etc., etc. And when you look at $6,538 on $50,000 of wages, your effective tax rate is 13%. So if you were to put money into superannuation and claim a tax deduction, you're actually doing yourself a disservice because the contribution rate is 15%. So by putting money into super thinking you're doing the right thing, you're actually hurting yourself from a tax perspective. Now, there are a range of reasons that you may want to do that, because you may have sold a property where you've realised a capital gain. You may have an income where your marginal tax rate is 34%, it is 39%, it is the top marginal rate, and that would give you a significant tax savings, because if you're earning $140,000 and paying 39% on the top end of your wages, putting money into super at 15 is a wonderful saving. So I'm a massive advocate of doing that. But I find a lot of people come in with a lower taxable income thinking they're doing the right thing. And when you go through these sorts of numbers and explain it, they go, oh, that's no good. Well, no. And what we want to try and point out today is keep that behaviour going, because adding to superannuation over time with any amount of money from a compounding perspective is great. But just make the contribution as a non-concessional contribution. So a lot of people are familiar with $30,000 as the deductible limit. But a lot of people forget that the tax-free contribution rate or non-concessional rate is $120,000 a year. So in this scenario, if you've put $20,000 into super thinking you're doing the right thing, you've paid $3,000 of tax because you pay 15% on 20 grand. You could save your wages, put that money into superannuation and pay nothing. And if all you've done is paid income tax at 13%, that's lower than the contribution rate going into super. So again, keep your behaviour going. It's wonderful. It's a great initiative. It's great forward planning. Massive advocate of it. But just make a non-concessional contribution and you'll pay no contributions tax. if you can save your wages. Now, if you've sold an asset or you've had a change in income or you've taken on a second job or you've started a pension from a defined benefit scheme and then gone back to work, then yeah, keep making a deductible contribution, but always assess, what is my taxable income? Because what you'll find is, depending on how your income is sourced, some of it may be tax-free. Some of it may be concessionally taxed with a rebate. So we see that with defined benefit pensions. You may have a lot of franking credits coming out of a company, and you're taking a wage out of your business with a load of franking credits, which is very, very tax effective. So work with your accountant or do some math in relation to your actual taxable income, because I'd love people to keep adding to super, but don't pay 15% contributions tax if your marginal tax rate is less than that. If you work in a job where you may be part-time, or you may work part of the year, you might do 2 days a week, you might do contracting work and not work for a full 12-month period. Check your contribution rate, and remember that you don't have to make a payment through super. You can make a payment at the end of the year with your own money and get exactly the same tax benefit. But let's not waste the non-concessional limit of $120,000. Because in this example, if you put $20,000 into super, it's going to grow in a tax-effective environment and compound. That's wonderful. It's going to increase the capital base from which you can take a pension from 60, either as an account-based pension or a transition to retirement pension. But you pay no tax putting that money in. And you can do that right up to 75 with no work test. So don't miss out on the non-concessional threshold, because a lot of people come in, sit down and go, I'm maxing out my 30,000. And then they tell me they earn 42 grand. And the look on my face says it all. And then we work through this exact conversation. So I thought I'd put it out there today to get people thinking, because, we're only partway through the financial year, and I'd hate for someone to work out that they've paid too much tax in June, thinking that they needed to salary sacrifice through their employer.
It's an interesting one, isn't it? Because people generally are putting extra money into their super because they're primarily motivated by the idea of increasing their balance.
Yes.
But they're also thinking in the back of their head about getting a tax advantage, aren't they?
Yeah, correct. And that's what I mean. The intention and the behaviour here is great. I'm not knocking the behaviour. I think it's wonderful. But if we can put the money in through exactly the same methodology but not claim a tax deduction, you're actually better off, so that you've got more in super, you'll have a greater capital base, and you're still building your superannuation so that as you get closer to retirement, you've maximised your cash flow over your working time frame, and you've got as much in there as possible that you could draw a tax-free income from at 60. So we're saying keep that behaviour going, but just think about making a non-concessional contribution over a concessional contribution, and you'll actually get more money in your fund, because your marginal tax rate at the moment isn't warranting a saving, because there's not enough of a difference between your tax rate and the super tax rate.
So if you're making roughly, well, for sake of argument, the $50,000 that you've been talking about, but you've sold off something, and all of a sudden you're flush with cash, you should perhaps consider putting maybe some of it into your super, but not all of it.
Exactly right. So this is where you want to have a chat to the accountant, because if you've sold an investment property, you've sold some shares, you've sold something, and we find this a lot with people that are employed by US tech companies, where they'll have shares vested in their name, and when they vest, they have a tax issue where it increases their taxable income. So regardless of the source of the additional taxable income, you want to be sitting down with your accountant in May, in the year the transaction's been done, and saying, all right, I've earned X in wages, because we know capital gains tax is just income tax by another name. So you might have a $50,000 salary where it's not worth making a deductible contribution. But if you've got another $50,000 of assessable capital gain from the sale of an investment property, for example, then yes, this would be a time where you want to maximise the limit, or use the catch-up 5-year rule so that you can maximise what goes into super, provided that you're eligible to use it. Making a deductible contribution can be really powerful, but we have to look at that broader, big picture number to make sure that there is that arbitrage between our potential income tax rate and the contribution tax rate of 15%.
There's a lot to think about. Today we're talking about making contributions to our super, but before we go back to that, during the break we had an inquiry from a listener who says he's got himself in a bit of a pickle, having not filed a tax return for several years, and he says he can't afford to go to an accountant, and he only makes about 50 grand a year. Now, I'm going to take the lead on this one, if you don't mind, Luke, because I know for a fact this is not a financial planner question.
Correct.
This is a situation where you need an accountant.
Correct.
And I would suggest that if you feel you can't afford an accountant, you're missing the point. You can't afford not to have an accountant, because the accountant is the person who is best placed to sort out that mess for you and do it with the minimal possible damage. You may end up paying a penalty to the government, but your tax accountant will be able to provide you with much better advice, and certainly a lot more specific advice than I can. And Luke, in the break you pointed out that if somebody is an employee taking regular wages or salary, the employer is taking the tax out anyway. So the chances are our caller may not actually owe any tax. He might even be owed a refund.
Correct.
But that refund will be reduced by whatever penalties are imposed. Talk to your accountant.
Yeah.
That's the important message.
And if you don't have one on that note, ITP, H&R Block, you don't need a big accountant. Just pop down and see one of those. They'll be able to fix it. It's not. Don't make it any worse than it already is through silly assumptions.
Yes, absolutely. And get onto it ASAP. The longer you let it go on, the worse it gets.
Yep.
Now, back to our today's question about maxing out our super contributions regardless of income. I think we've established it's not necessarily a good idea. So what should people remember about making deductible contributions?
Yeah, look, I think you first need to start with, what is my taxable income? What tax rate am I actually paying, without assuming that making them is good. Yes, it is great behaviour. Yes, it is a great initiative. Yes, it is wonderful behaviour that you're adding to your super and preparing for later. Massive advocate of that. I'm not saying stop that. I'm just saying make a different type of contribution. Don't claim a deduction if you're earning 50, 60,000, because as we said before the ad break, your effective marginal tax rate is 15% or less. And if you're paying 15% to put the money in, but earning 10, 12, 13% in wages, you're choosing to pay more tax for no benefit. If you're in that situation, make a non-concessional contribution to superannuation. That way you can still bolster your balance. You're still adding to super for later. Keep that great behaviour going. Just don't claim a tax deduction. And you'll actually end up with more in super than if you'd claim the deduction, because on our example before the ad break of $20,000, you pay $3,000 putting that in. A non-concessional contribution, you pay nothing. So you're $3,000 better off in that scenario because of the balance of your current marginal tax rate. So keep making those contributions, keep building for later if that's what you're doing, but just don't claim a deduction. If you are selling an asset, then work out with your accountant what is the sale going to trigger in relation to additional income, because capital gains tax is just income tax by another name. So if in our example you've earned 50 and you've got another 50 or more of income from the capital gains tax event, now you really do want to be claiming a tax deduction, because you could be paying tax at 34%. So the super contribution at 15% is a really nice saving. So work with your trusted advisor to make sure you can do that. You can make a non-concessional contribution up to $120,000. You may not need to use all of that limit, but just remember that the deductible limit is $30,000. The tax-free limit is $120,000, and you can do that right up to age 75 without having to worry about a work test. After 67, you need to meet a work test to make a deductible contribution. So think about what you're trying to achieve by putting the money in, and don't start with, am I trying to build super? You need to start by asking yourself, am I or am I not trying to claim a deduction? Because the behaviour of adding the money to super, you'll do anyway because it's great behaviour. But just think about your broader position. If you're unsure, go to your accountant in May, be proactive so that you've got a strategy leading into the end of the financial year, because you can put money into superannuation in June and claim 100% of that money in exactly the same way as salary sacrificing $200 a pay from July to June, you get exactly the same tax outcome. So you're not missing out on anything. You just need to be a little bit sharper about how you make your contribution and the benefit of doing so as part of your broader accumulation strategy.
So, Luke, where can listeners get more information?
Yeah, the office number, 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker, Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra, where you and I have a massive library of shows. And we have Smart Money Strategy, your ultimate guide to financial planning, which has an entire chapter on exactly this conversation.
Fantastic. And, of course, Christmas is just around the corner. It'd be a terrific stocking stuffer.
Wonderful.
Luke Smith from Envision Financial, thanks very much.
See you next week.
And Luke will be back again with us at the same time next Friday afternoon to talk about money matters once again.